Well, hello and welcome back to my channel Finance Wale Sir. And yeah, this time taking a break from Chat GPT and Google Sheets, as my channel is predominantly a finance channel and it will be helpful for financial analysts, finance students. And yeah, so in this video I'll be talking about some important, or I would say most important, finance interview questions with of course their answers. And well, this is going to be a series of videos, so this is the very first video. And yeah, I will be adding more and more questions, will be making more and more videos. So watch this video, please share your feedback, please share in specific kind of questions you think you get wrong, and I will try to cover those as well in the videos in the future. So well, let's move without further ado. Let's start. Okay, first of all, this agenda of this video. Well, these questions are relevant for jobs in fields such as investment banking, equity research, corporate finance, and consulting. So these questions are prepared keeping in mind these kind of job openings. However, if you are in a different field or aspiring for a different kind of finance job, yet you may find something of value in this video, so well, feel free to watch this video. And yes, this video is aimed at those people who already have some knowledge of finance. So even if you are an absolute fresher, you are expected to have the basic idea of financial concepts. This is an interview guide, it's not a course on finance basics. And yeah, this is an indicative list. These are the questions which are likely to be asked. There is no guarantee that you will be asked the same questions in any of the interviews you will be appearing for. So well, let's start with the questions. Okay, one very important question which is asked in interviews: what is minority interest and where can you find minority interest in financial statements? So the first point is, okay, minority interest is the portion of a subsidiary stock that is not owned by the parent company. So if a company A owns 85% in company B, then the remaining 15%, which is not owned by company A, is shown as minority interest in the consolidated financial statements of company A. So if company A owns company B but not fully, which means more than 50% but less than 100%, then what company A does not own, I repeat, does not own in company B, is minority interest for company A shown in its financial statements. Well, where can you find minority interest in financial statements? This is a question which is asked in interviews and candidates usually get it wrong. First of all, minority interest will be there only in the consolidated financial statements, because these adjustments will be shown only if the parent owns less than 100% of its subsidiary. So please keep in mind, there is nothing like stand-alone minority interest. Well, where can you find minority interest in financial statements? Well, let's see a real example. I'll show you an income statement and balance sheet. Okay, this is just an indicative income statement. This is not prepared as per any accounting standards. So please note, this just for an example. So here we have an income statement which contains revenue, other income, cost of goods sold, depreciation, etc. And it gives you operating profit or EBIT. I'm sorry, there's a spelling mistake. So I arrive at EBIT, then the interest expense and income, and I arrive at profit before taxes. I arrive at income tax, then profit after tax. So once I have profit after tax, then let's say if minority interest is 15%, as I talked about in my example, which means company A owns 85% in B and it does not own the 15%. So out of this entire 6800 profit, 15%, as you can see, this is multiplied with C19, which is the 15%. My consolidated profit after tax will be multiplied by what I do not own. So I multiply my entire consolidated profit 6800 by what I do not own. This is 15%, which is the same as 1020. This is the minority interest, or also known as non-controlling interest. So if someone asks you, okay, where will you find minority interest in the income statement, you would say it is below the profit after tax, because the consolidated profit after tax will then be divided between what is owned by the parent company and what is owned by the minority shareholders. Similarly, when you go to the balance sheet, this is a simple balance sheet. You have assets, you have goodwill, fixed assets, other long-term assets. These are total assets. Where do you find minority interest? When you come to equity and liabilities, and when you look at what's the equity. So what is the equity attributable to owners of parent company, and this part is owned by the minority shareholders. So we'll typically see minority interest in the equity section of the consolidated balance sheet. I repeat, you will see minority interest in the consolidated balance sheet. In fact, just to make it more simpler, we should make it 150 and this as 850, because we talked about 15%. So again, out of the entire equity, 15% is owned by the minority shareholders and rest 850 by the parents. So this is how minority interest is shown in income statement and balance sheet, and where exactly it is shown, because as I said, this is what is asked in interviews. Where will you find minority interest in financial statements? Coming to another question, so give example of 2 line items which are found in all 3 financial statements. All 3 financial statements are income statement, balance sheet and cash flow, and these are the line items you will typically find in all 3. Net profit, because net profit is there in the income statement, it's there in the balance sheet, because the retained earnings get added, and it's also in the cash flow statement. Similar is the case with depreciation, though please note that depreciation is actually added back in the cash flow statement. It is there in the income statement, of course. It is there in balance sheet, because in balance sheet you show the net assets, the net fixed assets. So you basically deduct the depreciation. So in a way, it is, you can find this in all 3 financial statements. The next question is very important. What is enterprise value? Well, enterprise value, we know, is a measure of the total value of a company. I want to value a company, I will calculate its enterprise value. It includes your market capitalization, debt and cash. So how it is different from other components is that it takes into account all stakeholders. It takes into account equity as well as debt. Market cap, what we call market capitalization, gives us a value of the equity. But what about debt? Even, in fact, enterprise value is also called as the theoretical takeover price of a firm, because this is the value one may think of when someone is acquiring a company, and it is for this reason that cash is deducted. Imagine you paying for a company. You pay for the market cap, you pay for the debt, because you are buying as per the equity value, you're buying the value of the debt as well, because eventually now you are supposed to pay the debt. You deduct cash because the cash of that company now belongs to you. So if you buy a house for 1000 rupees, I know it's not possible, but just for example, when you buy the house, you see that 200 rupees were lying there in that house. Those 200 rupees belong to you. So effectively, your value gets reduced by those 200 rupees, because you paid 1000 but you got 200, and that is the reason why cash is deducted. Another question is, how do you treat minority interest in enterprise value? Well, the simple answer is minority interest is added to enterprise value, or EV. This is important, because why we use enterprise value? Let's look at it this way. Enterprise value, or EV, is basically used for having valuation ratios or other metrics. You have this very famous EV by EBITDA, or you can have other metrics related to EV by sales, EV by profit. So basically, enterprise value is used as a relative valuation measure. Now, because the enterprise value, for example, if we have something like sales by EBITDA, for example, that is, this sales is for the entire company. The entire company, the parent company. That's why, for a proper comparison, we add to EV the minority interest, because we have to bring parity to both the numerator and denominator. When I am talking about enterprise value, for example, in EV, it includes value of the entire company. It, in a way, includes a minority interest in EV. So why not? It includes a minority interest because EBITDA there, is EBITDA for the consolidated entity. For example, it is EV by sales. the sales is for the entire consolidated entity. So when you calculate the EV in the numerator, you have to make sure that this EV also includes the minority interest, because in denominator, in one way or the other, you are including the entire amount, the entire consolidated value. Okay, this is interesting. For what kind of a company you will not prefer PE ratio? So we all know that PE ratio is a very widely watched and observed metric. But for what kind of a company you will not prefer PE ratio? You will not prefer PE ratio for a company which is high capex. Companies such as industrials, for example, something say a steel company, a real estate company which has high capex. Now with high capex, they will have huge depreciation and interest expense, because capex is usually financed by debt. So as a result, because of high amount of depreciation and interest, your earnings will get distorted. And many times such companies run in losses as well. As a result, because different companies have different capital structures, have different amounts of depreciation, have different amounts of interest expense, the earnings which you arrive at may not be useful for comparison. And that is the reason that EV by EBITDA is preferred, because EBITDA talks about core operational performance. To EBITDA, it does not matter what depreciation was there, how much interest you paid. It talks about the core operational performance on the basis of which you arrived at an EBITDA. So in those cases, you have huge debt, huge capex, your earnings are not useful for comparison, because one steel company, if you compare the steel company, some may have different debt structures, may have different amount of assets which are being capitalized and then depreciated. To arrive at a common platform, you arrive at a measure which focuses on the core operational performance. They may be having huge different amounts of debt or capex, but what matters most is what they are doing operationally. Another example wherein we will not prefer PE is banks, because banks have huge provisioning expenses, which is a mandatory requirement. This affects the amount of profit, which makes PE unfit for comparison, because each bank will have a different type of expense of provisions in their income statement. Some of them may want to present a better amount of return on the earnings and all, so they will be charging in every quarter, in every year, in a bit different manner, and it heavily affects the amount of earnings, because this is a mandatory expense, and bank is such a business wherein provisioning is required. That's why we use price to book ratio instead of price to earnings, because price to earnings, because price to book, when it comes to book value, price to earn when it comes to book value, earnings form a small part of the entire book value. The next is, what is a cheaper source of finance, debt or equity? Well, interestingly, debt is a cheaper source than equity. We all think of that debt may be a expensive source, but debt is a cheaper source, because first, interest on tax debt is tax deductible. Secondly, cost of equity is generally higher, because investors take a higher risk when purchasing shares and thus require higher return. If you are aware of the concept of WACC, you know that WACC contains, so the weighted average cost of capital contains both cost of debt and cost of equity. And the reason we mentioned why cost of equity is typically higher is because investors would like to have a higher return. There is no guarantee of payment, just it is in the case of debt. And this is the last one, and this is an interesting one. These kind of questions often confuse those who are getting interviewed. Assume two companies, A and B, with B having no debt. Which one will have higher WACC? I say, out of companies A and B, company B has no debt. So which one will have a higher WACC or weighted average cost of capital? Well, the answer is B. Read it again if you are getting confused, or if you are not, well, let's move to the Excel. I said, if company B does not have debt, it will have a higher cost. So, well, let's see what it is about. Now, say for example, cost of equity is 12% and cost of debt is 6%. Then these are the weights. I will explain why the formula is like that. For the time being, let's assume they have equal weights. So the weighted average cost of equity is very simple to calculate. I just multiply the cost by the weight. similarly is the cost of debt. Now assuming a tax rate of 30%, my after tax cost of debt is 3% into 1 minus 30%, which is 2.1%. And after tax cost, it's not applicable here, so it's simply the weighted average cost, which is 6%. So 6 plus 2.1% is 8.1% is the WACC. Now for example, now we have a company which has no debt. If there is no debt, then of course there is no cost of debt. This is 0. All this is 0 because there is no cost. Now the weight will be 1 because it is the only source of capital. There you see 12% is multiplied by 1, or 100 as you may say, 100%, it is 12%. So you see the moment, and then 12 plus 0 is 12. The moment I removed debt, no debt, my WACC increased. If I go back to the previous example where it was 6%, you see WACC reduced. Why? Because it is the after tax component of debt which is reducing my cost. Also because it has certain weightage. Now let's say instead of 6% it is 8%. WACC is 8.8%. Of course it has increased. But let's say now cost of debt instead of 8% is no debt. So again I remove it. Then again it comes back to 12%. This all becomes 0. My weight becomes 1, which is 100%, and my after tax cost or cost of equity is 12%. This formula just indicates that if there is no cost of debt, which means in the event of no debt, this automatically becomes 1, the weight, or 100%, because entire capital is now equity. I come back to 6% again. Let's play around a little bit and let's say that the weight is instead of 50, it's 30%. Now this weight will automatically be 0.7 or 70%. Now my WACC is 9.7. Once again, if I remove the cost of debt, or if I remove debt altogether, you see again this increases to 12%, because this entire thing goes 0, and the one which has the higher cost, it has a higher weightage now as well, because remember this is a weighted average. You can't say that okay, I remove the debt and this weightage will still remain 0.5. No, it will have the entire weightage to it, because there is no debt now. We are calculating weighted average cost. So well, these are some of the questions, as I said, are asked, are usually answered wrong. I'll come back to you in next video very soon with more questions and more answers. Please note that these are not very detailed explanations I'm giving, because my idea is to make you aware of what is asked and how to actually approach. So well, this is it for now. Thank you for watching this video. You can mail to me at financewalesir@gmail.com. You can come up with any questions related to finance. Please subscribe to my channel if you haven't, and well, see you soon again in another video.